There's no doubt the Fed has been wrong on their transitory inflation call. Yes, some of the price increases are transitory. A lot of them are not. And the market's expecting 2 Fed hikes next year. That, to me, looks pretty much on the money. But they're expecting 5 rate hikes from the Bank of Canada, 4 from the Bank of England and 3 from the Reserve Bank of Australia. And, to me, the latter 2 of those, the Bank of England and RBA, they look at very aggressive pricing in the futures markets. And I certainly can't see the RBA doing 3 hikes next year because, wages are still going to be pretty subdued by the end of next year. And that's the RBA's, mantra. That's what they want to see up at 3%. And the Bank of England, to me, I think it's going to struggle to raise rates more than just a couple of times because the UK economy at the moment is still pretty weak. It's got depressed demand. The September quarter growth was pretty underwhelming. It was driven by inventories and government consumption and not by the private sector. So, I think the pricing's right for the Fed, but for other central banks, I think it's a bit too aggressive at this stage.
Right. Okay. Well, then when it comes to investment decisions, you're going to have to be selective depending which market you want to invest in. So what do you like out there? Of course, we have yields rising slightly again. That's been pressuring the tech stocks over the last few days, particularly evident here in Asia as well. So how do you trade all of this? Patchy moves when it comes to global central banks. It's going to be on a case-by-case basis. So as an investor, what do you do?
Yeah, it's a great question. I mean, in the end, tech's done pretty well. Since the trough of US Treasury rates in early August, tech and consumer discretionary, which is very tech-heavy, they've actually outperformed sectors like financials, which you would have thought would have benefited tremendously from a steepening of the yield curve. So we haven't really done a lot in our real return fund over the past month. So, our primary risk exposures are, for example, in Europe. We still think that's a region which has got pretty good growth dynamics. Budgets are coming in better than we expected. The ECB is going to continue to provide liquidity. It's not going to raise rates anytime soon. So we tend to think markets like Europe, markets like the UK are probably going to do better than markets such as the US. And so we're kind of playing the higher interest rate dynamic through the equity market. We certainly don't hold duration as a portfolio diversified. We've got a lot of option protection on instead. But really that's how we're seeing the risk markets at the moment. Our overall risk exposure is pretty modest. But at the moment, central banks have got the markets chloroformed. So bond yields are grinding high. They're certainly nowhere near the growth and inflationary outlook that is out there. So bond yields should continue to move up, but central banks are going to try to hold them to a certain level, even though they're guiding about reduced asset purchases and also the need for higher interest rates. They certainly don't want yield shooting through 2%. That'd be a big problem for them and for the markets.